Hey, welcome to the show. Total Financial Solutions, Safer Money Hour. Arif, Halaby, Jeff Gerard, talking about your family's finances. Of course, getting out of debt, managing your life, planning for your future. What is it all about? Every time we turn around the news, I think, or whatever you might pay attention to, radio or TV, is saying things that they assume we understand. The Federal Reserve is raising rates. Bank lending is unemployment is at all-time high, low. And you don't know, are those things supposed to be good? Do we want higher? Do we want lower? Is it better to have more or less? So what I want to do is spend this hour kind of demystifying some of the things that we take for granted in the financial world and maybe in the media world, where every time we turn around, they're trying to tell us something about an economic condition, assuming that you have your master's degree in global economic recovery. You're like, well, what does that mean? Well, Jeff, did you know that the SDRs are soon going to be adding to the basket of currencies the renminbi, also known as the yuan? China's look, no, don't turn the radio dial just yet.
Yeah, what language was that?
And those are things that are happening today and could ultimately affect everything from your savings account to your kid's college fund, even your pension that you may not even be expecting to be receiving for many years to come, because the way the system is set up, maybe you're just not old enough to get it. But do you know that things that happen right now could affect whether or not you receive that pension and when you receive it? And right, so all of those things are intertwined. Let's start with very basic scenario. What is the Federal Reserve? Well, the Federal Reserve is an independent. It is not a government agency. It's basically, I'm gonna water it down a little bit, but you'll get the concepts. It's basically a company that has contracted with the U.S. government to print and basically control the money supply in the United States. And they work directly with the Treasury, which is a group. It's an appointed position by the president and affirmed by the Senate. And then the Treasury is a bunch of also employees, of course, that are just have a job. That's their job, is to manage, control, work with banks and how the money flows back and forth. But all the way back, the Federal Reserve's job is to print the money and to basically, in not so many words, tell the government what to do when it comes to its currencies. There's always this conspiracy, the Federal Reserve is this or the Federal Reserve is that. Well, that's all exciting. However, what does it do for you every single day when the Federal Reserve is going to raise interest rates or they lower interest rates? You know, Jeff, think of it as two banks, Bank A and Bank B. If Bank A gets a huge loan coming through and I come in and I want to borrow $1 million, well, does the bank have $1 million in the vault with my name on it?
They do not.
So where are they going to get the money from?
They have to borrow it from other banks. I realized that the first time I went in to borrow, sorry, not borrow, but withdraw, I think a significant amount of money, but not so much that it would break the bank in my eyes. Certainly not more than I had in my account, or at least what the statements or the ATM told me I had in it. And when I went in and asked for that money, they said, "Oh, well, we don't think we can give you that much."
Yeah. Try to go in and ask for 10 or 20 or 30,000.
It was $9,000. $9,000. I thought, well, gosh, come on. This is a bank. Come on. Okay, you know what? I'll even give you this. It was a credit union.
Wow.
But to walk into a financial institution and have that awakening, that sobering realization that, gosh, they don't have wait, where are the other rest of the monies with my name on it in my account? It just doesn't exist. And I think people lose sight of that there's not a physical amount of money just sitting there, or a bunch of gold bars back in it, for that matter, which some people still think exists.
And they'll tell you, look, we have to order it.
That's right.
And you think, order it, but where's the bank
tomorrow?
Ordering it from? Is it like UPS comes by? And you know what I always thought that was interesting, and so don't tell anybody that I told you this, but you know how they say, the driver carries no cash. There is no value, anything of in your delivery trucks, your UPS, FedEx, DHL. The truth is, sometimes there is. Right? If I send you a package of money in a envelope through any of your local delivery companies, nobody knows what's in it. right? They don't open it up and go, oh, this is a contract for Arif to buy a new car. Oh, here we go. Or this is a paperwork for client X. So money is transported to a credit union or a bank or an institution when you need it. You call up, say, hey, I'm going to be withdrawing $25,000. Oh, that's a lot of money. You know, that's why they only allow you to pull out $200 or $300 or $400 from a credit union's ATM, is simply because they could run out of money. Simple, very simple. But you would think in the back, well, we don't want to keep all of our eggs in one basket because what if we're robbed or there's an emergency? So in the banking system, if you want to borrow $1 million for a new building or a business or $100,000, if the bank or the credit union doesn't have those ones and zeros, because really that's about all it is.
That's right.
It's a ledger system. Then they have to go to another bank and borrow it. So they'll borrow it for a particular number and then sell it to you or lend it to you at a different number. So here's a good example. If Bank A needs the money to lend to a customer, they go to Bank B. Who sets that interbank rate when it's just two banks talking to each other? Generally, it's the Fed, the Federal Reserve.
That's right.
Will say, okay, if you're going to borrow from our currency, says the Fed, if you're going to borrow our currency, you're going to need, or you can borrow it between each other for 1%. Well, now, if Arif comes in to borrow the money for a building, they're going to charge me, let's say, 5%. So who keeps the difference? Well, the bank. Bank A. That's their profit. They'll move money from one place to another place. They'll pay those people a percentage, 1%, let's say, per year. And yet the extra amount that I have to pay, they get to keep as a profit. Same thing if you bought a car, if you buy a house or a boat or a truck, whatever. Those dollars, the difference is kept. But what if that big bank doesn't have that kind of money sitting around? Where are they going to borrow it from? Directly from the Federal Reserve. So the Federal Reserve is a place that holds money. It holds buckets of dollars. It goes back and forth. And the reason that this is important is because if a bank, as in 2008, 2009, when they were forcing banks to take big buckets of dollars, even if the bank was healthy, the bank says, oh, no, we're good. We managed our assets well. We didn't have bad loans. We have people paying on time. We're pretty good. The government still required, and the Federal Reserve still required, banks that were healthy to accept big chunks of dollars. And when they did, they also restricted how they could lend them. So if you were a bank, you had a big bucket of dollars that were just forced down your throat, and you have to pay interest on those dollars. And at the same time, you couldn't lend it out so that you could make money on those dollars. They were basically, think of it like this. If I came to you, Jeff, and I said, hey, you got a brand new Ferrari.
I like it.
You'd love the Ferrari.
Where are the keys?
It's right here.
Oh.
And the state of California, just so you know, requires you to pay or to buy auto insurance.
That's right.
And you're like, great, well, hey, look, I'll drive it to and from work. It'll be fun. It's a nice Ferrari. No. Here's the keys to a new Ferrari, but you cannot drive it. You lock it up in the garage. You still have to buy another car to go back and forth to work.
That's right.
But you have to pay insurance on that Ferrari that's locked in the garage. So when they require FDIC, Federal Deposit Insurance Corporation, on the dollars, the banking institutions have to pay insurance on money that they cannot lend out. And now you end up with a group of banks, banking system, that are paying insurance premiums. Now, by the way, why would the Federal Reserve and the Treasury and the U.S. government do this? Well, look, there's many reasons. But when you had the FDIC, when you had, I think we're up over 600 banks. I'll come up with the number here in a minute. It's over 500 banks that have gone out of business. Poof, kaput, gone. Not branches, banks in the last, since 2008, 2009. When those banks are gone and the FDIC, the insurance company, has to come in and pay depositors those dollars, they start running out of reserves. They're like, uh-oh, our savings account is dwindling. How are we going to get more money into our insurance company? We need more policyholders. We need more money. So banks had massive amounts of dollars sitting in their books. They were forced to buy FDIC insurance on some of those dollars. Those insurance premiums go right back into the FDIC, and surprise, it's now worth a lot of money, and it's now filled back up, and not completely probably, but it's getting there. So what you end up with is the Federal Reserve decides who is being charged what interest rate, when, and how, and at the same time they're also deciding how much money can circulate. So that's what the Federal Reserve does. Now, why does that matter to your pension? Arif, that is so Harvard MBA stuff. Yeah, I know. But it's really simple. Because if you ever put money in a bank in 2005, we had a client come in the other day. He had a 10-year guaranteed fixed annuity, 6.3% for 10 years. Wow. Every year for no fees. Paid every year, didn't matter. Come heck or high water, didn't matter. Anything, he was getting paid that. That's pretty darn good in today's, right? You can't beat that with the stick, as they say.
And smart of that person to lock it up for 10 years at a time where it was probably the height of interest rates right around that time, especially coming from a bank.
That's right. And so he ended up in a place where he's like, well, I wouldn't want to change this. I wouldn't change it either. You're in such a great position, I think I wouldn't change a thing.
Yeah. And that's part of the challenge as people start to make some of these long-term commitments with their dollars, retirement accounts, whatever have you, in a time when, you know, when rates were high and it's working, the math is working in your favor. That's a wonderful thing. Gosh, I mean, especially now, hindsight being 2020, think of it now. If you could find a bank CD that was paying 5%, wouldn't you say, oh, a 5-year, I'll take a 10-year. Give me a 20-year CD at 5%. Wouldn't you do that? So kind of the same thing existed back then. We didn't know that was coming. And I think probably a 10-year account from a bank was probably, gosh, maybe the longest they would go at that point. But you know, nobody knew that the world would change so drastically, and that now that would be that type of interest rate, which back then was like, just decent, I guess, middle of the road. But now it's revered as, wow, how can anybody even possess something like that? Well, it came from the old, you know, economic landscape, the old environment, the way things used to be. But now that things have changed, we have to kind of look out for ourselves a little bit differently. And I think something else you brought up is very interesting, Arif. You're talking about the banking industry, the interest rate environment. We basically are playing a game where there's only so much money, aside from printing new monies, in circulation. And if banks don't want the money, if banks aren't attracting us, where do people normally go if they want a higher rate of return?
Well, sometimes they have to take a higher risk.
That's right.
And so you'll go to places that are much higher risk for money that was never designed to be at risk. In other words, it's to repair the roof, or your daughter's attending college next year, or your son's wedding next month, or monies that were never designed to be at higher risk. You've instead taken those and put those in a place. And banks often will say, we just don't want the money. We don't need it. We have plenty. Today it might be a little different for some banks, but we're at 543 banks according to the FDIC. Not branches, banks.
Banks.
From Hawaii to Arkansas to Connecticut to California, Georgia, Washington State, DC, you can go on and on. These are banks and branches that have closed. 543 banks that are out of business. So I share that with you because I want you to know that the FDIC's job is to protect your money. That's what they do. That's why you have insurance on your money. And what it does do is it means that that insurance bucket can go down. And so expect banks to keep interest rates low so they can make payments to the insurance company, to the branches there. Expect it to be low. If you are a saver, you used to, because I used to. I remember when I started saving pretty aggressively, like 1986, 1987, and I would invest. I would put my money market account was earning 6-7% interest.
Jeez.
And I remember I got a renewal one time, and I don't know, maybe the last time I checked it might have been months earlier or something. And I said, well, what is my average rate? What is my interest rate now? And they said, oh, your money market is now 5%. I thought, oh, this is incredible revolution. How can this happen? Well, that's the interest rate today. I said, you know what? Transfer everything over to the stock market. because I had a stock mutual fund accounts.
Wow.
So they left my money market account. I left my money and went over to the market. Oh, boy, did that hurt them. Because money that could never be feed, I just gave them 5 1/4, 5 3/4, whatever the fee was. Yeah,
right.
It shows you what an 18-year-old knows. And so what you end up doing, I think, for most people, is they make decisions in a very short-term basis. You make decisions that are not meant to be long-term decisions, but they do affect you long-term. So let's keep our eye on here. Remember the number I gave you? Right, it was 543 banks.
Yep.
What is as of what date? Well, are you ready for this? It is as of 2000 and I want to say 8, but let's make sure I'm right here. 2001, we had 1, 2, 3, 4, 5. As of 2008, we're over 530 banks. That is a hard thing for us to absorb, because what used to happen was a run on a bank. People would find out Bank X had a problem and everybody would run and take their money out. Well, because banks don't keep money, as we just indicated, locked up in a drawer with your name on it, instead, what does a bank do? A bank takes your money and they lend it out to other banks. They keep enough on hand for what they need for the day or the week, however they structure their internal. But then they lend it out to individuals, they lend it out to other banks. But if they have a surplus of money, they'll send it back to the Federal Reserve and say, you know what? We don't need these dollars. We don't want to pay interest on them. So here, take it back. It's like you getting a bonus and paying off one of your credit cards that's a 30% loan. You say, look, I can keep money in the bank and I'm earning a very low interest rate here, or I can take it and move it over here and pay down the credit card, and now I don't have to pay any interest. So banks will do that. They'll shift money around, often overnight. You know, it's fascinating to me. When I was a policeman, we had a guy on Ventura Boulevard from Encino to, let's say Woodland Hills out to Toluca Lake, right? That whole stretch of Ventura Boulevard in the San Fernando Valley. That was the bank robbery capital of the world. We were getting 2 and 3 bank robberies a day on that street. Incredible, huh?
That's incredible.
So police officers would just troll up and down the street. A call would come out. Oh, we just passed that bank. Oh, it's in front of us. And I remember on one particular occasion, we get a call. We go in there, and we said, okay, what happened? You know, you wait for the FBI, because the FBI come in and take over. We just did some of the initial paperwork. But we walked into the bank. We said, oh, my gosh, what happened? Everybody okay? Yeah. Well, the guy walked up, and on a note, he said, transfer, and I can't remember the number, whether it was $100,000 or $1 million, whatever it was, but he said, transfer this much money in my account right now, or else, whatever the note said. So the lady said, yes, sir. Click, 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 and he said, and give me a receipt. Yes, ma'am. Yes, sir. Poof. Gives him a receipt. The guy walks away, thinks that he has $1 million in his account, or whatever the number was. Yeah. And she summarily just reversed the transaction as soon as he walked out the door. And oh, by the way, we know who you are. Yeah, we because have your account when you number. Open your account, it's your account number, and we figured it out. We had somebody who would rob a bank once, and he wrote the demand note on the back of his deposit slip. Oh, well, that's smart. He left it. And on the other side was his address. Guess who was waiting for him? Oh, surprise, when he got home. So banks don't lose. They are set up today to be very structurally sound. They will still, we have over 500 of them that have gone out of business. But FDIC, new companies come in and they buy up the old bank's assets. So you're still protected. I think it's now $250,000 per account. So you're still safe. You're there. You have your money in the bank. That's not a problem. The concern, though, is what kind of interest are you being paid? And if the Federal Reserve decides to increase rates, one of the winners is going to be, and mostly it's our seniors, because frankly, think about it, if you're 25 or 35 years old, you probably don't have a lot of money saved right now. And if you do, certainly it's not in a bank, it's at your work 401k. That's normally the way it works. So what do you do if you are structurally trying to fix your life, and how does a bank fit into that? And what happens if you're a senior and you're trying to save? We'll come back in a minute, and I want to get into the next steps of whether or not the Federal Reserve raises rates. How is that going to impact you as a saver, an investor, or somebody even potentially going to get a pension, whether it's from the city, state, county, a union, a company? Does it affect you? And the answer is yes. We'll get to that when we come back. I'm Arif Halaby. That's Jeff Gerard on Total Financial Solutions Safer Money Hour. We'll be right back.